Yeah, so we had thought that with inflation coming down, with unemployment still low, they're the kind of conditions that are normally supportive for global growth. But like we mentioned earlier, it's all about oils. An oil shock, it's a tax on global growth, boosts inflation, and basically we sort of think about a sustained $50 move higher in crude that hits global growth. It causes central banks to reassess whether they need to raise interest rates. So that can completely throw out what the global growth outlook looks like, particularly for the first half of this year.
This is Converge,
a podcast from Convera.
Come with us as we shape the future of finance.
Welcome to a special Converge Market Update. Normally, we'd be joining Steve next week, but we brought in Steve and Dooley today. He's the head of market insights at Convera to discuss, of course, lots going on in the world that has the great potential and already is impacting markets. Over the weekend, as we all know, the U.S. and Israel launched major strikes inside Iran, including hits on military sites and senior leadership, and Tehran is firing back across the region. Oil prices have jumped, safe havens have rallied, and traders are asking one question: how does this end? And what does it mean for currencies and risk management? It's a very, very loaded question. And I'm joined, like I said, by Stephen Dooley to unpack all of this. So, Stephen, what has happened so far and where to begin?
Well, thanks for having me on, Alex. Yes, so early Saturday, Middle East time, coordinated US and Israeli strikes hit targets across Iran in what Washington has called a campaign to cripple Iran's military capacity and prevent a nuclear weapon. Multiple outlets now report that the operation struck command facilities, air defenses, missile and drone sites, and airfields, with waves of munitions launched from air, land, and sea. Since then, Tehran has responded quickly with missiles and drones right throughout the Middle East, targeting Israel and US-linked facilities across the Gulf, Bahrain, Kuwait, Qatar, UAE, and beyond. While Israel has expanded strikes into Lebanon against Hezbollah. The casualty figures are evolving, but Iranian state-linked sources and international reports suggest hundreds killed in Iran and fatalities in Israel and several Gulf states as well.
Yeah. So, Steve, how have financial markets reacted to all of this so far?
Well, financial markets have become much more accustomed to geopolitical shocks. If I can engage in a brief moment of self-promotion, we covered this in our flagship Are You Ready for 2026 report we published last year. Since 2015, the frequency of geopolitical shocks has increased rapidly, creating this stop-start effect in volatility and markets. So that's often how markets react to geopolitical shocks, but this time is different, and it's really because of the impact of the increase in oil and energy prices. Now, oil spiked around about 15% on average on fears of disrupted flows through the Strait of Hormuz, which is this choke point really between Iran and the UAE and Oman, where around 20 to 25% of the world's seaborne crude flows through. Now, we've already heard that this has been almost completely shut down, and some analysts flag scenarios that could push Brent towards 100 if this disruption persists. So that impact on oil, how it flows through to impact growth and inflation, is absolutely key. In other markets, gold, bond markets have been very much supported. Bond markets in particular, we'll come to that in a moment. And so the overall playbook looks pretty familiar. Energy up, those cyclical stocks, those stocks that are tied to consumer spending have been hit, and volatility has really continued to climb. And that's how it's a bit different to some other shocks. Sometimes we see this stop-start effect. Volatility has continued to climb, and that's markets telling us that they're worried that this could be much more persistent. So it's clearly a bigger macro shock than the recent flare-ups we've seen, and precisely because the Strait of Hormuz is a risk to the global supply story, not just a single producer story.
That's right. Yeah. So what's been the story in FX markets?
Well, the US dollar's been the major story, like we've been talking about nonstop for the last 18 months, Alex. The US dollar's been weakening really since Donald Trump's second election win. And that's been a huge story over and throughout FX markets. But the US dollar has made a roaring comeback. First of all, due to its safe haven status. So investors look to security during times of geopolitical risk. They buy the US dollar, they buy US bond markets. But more importantly, the US, which is now a major oil producer, also benefits from the rising oil price as well. So after sort of 18 months of being unloved, the US dollar has really been boosted due to those twin effects of safe haven and its status as a oil producer. Other markets, we've seen big losses in the euro and the yen. That's because higher oil is basically a tax on the big importers like Europe, like Japan. Europe and Japan are the most exposed to energy price spikes. So they have been particularly pressured. The yen's also been pressured by a story from last week where they've appointed two policymakers to the Bank of Japan board that are keen to cut interest rates. So the yen, which normally acts like a safe haven, hasn't acted like a safe haven. And that's been one of the interesting takeaways of the last few days. Otherwise, the Swiss franc, which has been the dominant safe haven, even as the US dollar has weakened over the last 18 months, the Swiss franc has just continued to outperform. That's been super strong over the last year and a half. And of course, gold, we've talked about that so much, up from 2,000 at the start of last year to above 5,000 now. That's absolutely surging. The other takeaway is that the emerging market FX, so your developing economy FX, absolutely slammed. And on Tuesday, they had their worst day since 2023. So it's had massive implications for FX markets.
Very interesting. So, I mean, how does it all end in your view? And I know you can speak from our partners at Oxford Economics as well here.
Yeah, so Oxford Economics put out a great note yesterday thinking about we're going to be talking about this in a bit, because when it comes to economists, financial managers, risk managers, we just don't know how things will play out. And so it's really about scenario planning. If A happens, then B. Oxford Economics have outlined three potential outcomes. First of all, a truce as Iran agrees to talks. So outcome one, Tehran agrees to talks on US terms, possibly trading denuclearization and limits on missiles for survival. It's humiliating for the current regime, but the regime lives to fight another day. Any truce could be short-lived if Iran then balks at the proposed terms while US forces are amassed. Scenario two, a truce without talks or concessions. If Washington or Israel come under political pressure or run low on ammunition, grudging truce with a status quo is possible, similar to how the attack on Iran last year ended. Unsustainable for the long term, but it's plausible. It's what happened last year. And then the real unknown is if we see regime change or a collapse. And so all the calculations change depending on who takes power and whether, anarchy follows, which is, something we've seen in other parts of the Middle East when existing regimes have fallen. Away from those three key scenarios, there are wildcards. If Iran sinks or damages a US carrier, if we see intervention from Russia or China, both improbable, but as we've seen over the course of this century, what could be the expectations of a short campaign in the Middle East, really anything can happen. But they're the three key scenarios.
Yeah. So what does this mean for the macro outlook? How will this impact growth most likely in 2026? Because up until recently, the team has been positive on growth, haven't they?
Yeah, so we had thought that with inflation coming down, with unemployment still low, they're the kind of conditions that are normally supportive for global growth. But like we mentioned earlier, it's all about oils. An oil shock, it's a tax on global growth, boosts inflation, and basically we sort of think about a sustained $50 move higher in crude that hits global growth. It causes central banks to reassess whether they need to raise interest rates. So that can completely throw out what the global growth outlook looks like, particularly for the first half of this year. And of course, a rapid rise in oil prices can be the trigger for stagflation, where inflation rises but growth is slow. And that's one of the trickiest scenarios for policymakers to manage. So shows you how problematic this can be. And so that's why, as I mentioned, the policy reaction is key, because yes, we'll see a increase in inflation from higher oil prices, but how will central banks look at it? Will they say, well, we can just look through this because this is a short-term impact? That's what we're starting to hear from the Federal Reserve. Or will they say, we can't afford to take any chances, inflation's already high, we might need to lift rates quicker than expected? That's what we're already hearing from the Reserve Bank of Australia. So we're already hearing the two different ways of approaching this in the first, 72, 96 hours of the conflict from central banks. So Bloomberg, again, thinking about how we manage these kind of periods, Bloomberg is thinking about three scenarios here. The conflict continues, oil hangs around $80 per barrel, but inflation expectations remain anchored, mean that we'll probably only have a moderate impact on growth and less impact of central banks raising rates. Second, if the conflict escalates, oil goes above $100 per barrel, but inflation expectations remain anchored, that can see some more moves in FX markets, because the Fed could probably hold steady while the ECB and the Bank of England might look to cut rates. So that would see a stronger US dollar across markets and weakness in the euro and in the British pound. And then the third scenario that Bloomberg talk about is if the conflict escalates, oil goes above $100 per barrel, but then inflation expectations rise, then central banks around the world need to tighten. And that's where growth faces a major hit. High oil prices, high inflation, and rising interest rates. That's kind of the doomsday scenario for financial markets. So again, thinking about what could happen, no one knows, but thinking about how the outcomes might play out is the only sensible way we can handle a period like this.
Very interesting. So, you spoke about FX, but what does this really mean implication wise for risk management within the FX space?
So, I guess from one perspective, the tried and tested FX management processes should just remain in place, but they really grow in importance for businesses in these times. So that's about, protecting and managing your cash flow, hedging in layers. So regularly hedging rather than making, one big decision, scenario test aggressively, like we mentioned earlier, and monitor the kind of macro triggers that might dictate FX behavior. So, in sort of volatile markets like this, it's really not about predicting the outcome, because as we sort of said time and time again today, it's just impossible to know how these things can play out. But as we sort of mentioned, we've got a good idea about the kind of outcomes that we could see. So that's really that's the best way for businesses to think about how things might play out. So scenario test your exposures, run a couple of different views. So what happens if oil jumps, the US dollar is stronger, and then that sort of resolves quickly? Or what happens if it's more long lasting? The US dollar is stronger for a longer time, the euro and the yen weaken for longer as well. So they're the kind of ways that you should be thinking about. What happens if this is short term? What happens if this is long term? And then sort of think about doing it now, thinking about your risk management now, that scenario testing now, rather than waiting for another big move to happen, because you want to be able to make the decision yourself as a corporate risk manager. You don't want to have the market force your hand with a sudden sharp movement.
Yeah, good advice to end on. Well, that's where we are. This fast-moving conflict, oil-led macro risk, and a stronger dollar bias. Thanks, Steve, for breaking it all down. And given the pace of rapid change, I'm sure we'll be seeing you back here in the seat a week or two from now. Thanks so much.
Great to be on. Thank you.